Our moderator, Tom Cole, is Senior Counsel at Sidley Austin. Tom has been involved in dozens of public company mergers and spin-offs, transactions often valued at more than $1 billion each. He taught the corporate governance seminar at the University of Chicago Law School for 5 years, ending in 1998, and began teaching it again in 2013. He's a trustee of the University of Chicago and former chair of the board of Northwestern Memorial Healthcare. Our first panelist, Michele Edkins, is the managing director at BlackRock, a $5.1 trillion asset management firm. And she is global head of its investment stewardship team of 22 specialists based in 5 key regions internationally. In this role, she is responsible for the team's engagement and proxy voting activities in relation to the companies in which BlackRock invests on behalf of its clients. She currently serves on a number of industry initiatives to enhance governance and sustainable business practices, including the Advisory Council of the International Integrated Reporting Council, the U.S. chapter of the 30% Club, which is a market initiative to increase the number of women on boards and in senior management, the International Institute for Sustainable Development, the Sustainability Accounting Standards Board Investor Advisory Group, and CECP's Strategic Investor Initiative. Our next panelist, Peter May, is president and a founding partner of Trian Fund Management. Peter, along with Nelson Peltz and Ed Garden, founded Trian in November of 2005. Trian invests in underperforming and undervalued public companies and looks to work constructively with the management and board of directors to create lasting shareholder value. Peter is chair of the board of trustees of the Mount Sinai Health System in New York, where he led the turnaround of this major academic health center from serious financial difficulties to what is today one of the most profitable and fastest growing academic medical centers in the United States. In addition, Peter is a trustee of the University of Chicago and a life member of the Advisory Council of the University of Chicago Booth School of Business. Our final panelist, John Rogers, is the founder, chair, chief executive officer, and chief investment officer of Ariel Investments. The firm offers 6 no-load mutual funds for individual investors and defined contribution plans, as well as separately managed accounts for institutions and high net worth individuals. After working for 2.5 years as a stockbroker at William Blair, John founded Ariel Investments in 1983 to focus on undervalued, small and medium-sized companies. Beyond Ariel, John currently serves as a board member of the Exelon Corporation and McDonald's Corporation, and is the past chair of the Economic Club. Please join me in welcoming Tom, Michele, Peter, and John.
Thank you for that introduction. You left out one thing. Only one of us up here beat Michael Jordan one-on-one in basketball. There are how many million hits on that video now?
5 million.
5 million hits. Okay. It's not 5.1 trillion AUM, but it's not bad. So I'm Tom Cole, I'm that guy. This is what we're going to talk about. I'm going to give us about 5 minutes of level-setting slide discussion, and then we're going to get into the really important questions. And the ultimate question being, is activism good for the economy? I can't wait to hear what we all have to say about that. Who are the activists? Well, there are 3 basic orientations. It's not to suggest that activists sit solely in one of the orientations, but there are governance activists, CSR activists, and financial activists. Peter, I think you would say you're a financial activist. Yes? Pretty close. The governance-oriented activists come from a variety of spots. There are active fund managers, passive fund managers. This is kind of an important point. You can be a passive fund manager in the sense of a passive strategy and yet be an activist, particularly when it relates to governance matters, because say you're an index fund, that's your way of improving the portfolio. You can't get in or out of the index stocks. Pension funds clearly become governance activists, and there are others, academics, particularly coming out of Harvard, the proxy advisory firms, and there are associations of investors as well. So the governance-oriented activists are after a bunch of things, usually best practices, and they've had great success. annually elected boards. There was a time when a majority of the S&P 500 had staggered boards. Now it is a small minority and probably getting smaller. Separation of the chair and CEO, that's a good example of basically the global economy of ideas for governance. This is originally a UK notion. It has clearly been imported here. Shareholder calls, special meetings, majority voting, proxy access. And then shareholder engagement. There are a number of sources of this theme. The theme is basically that boards of directors should be more engaged, particularly with the institutional holders. We can talk about that more in a moment. On the financially oriented activists, again, this is probably too simplified a taxonomy, but they fall into these categories. There's the income statement focused, which I think Peter would say Trian does, which is where they seek operating improvements, often management changes. They have a longer term investment horizon. And very importantly, they can be industry sector specialists. Some of the activist hedge funds have industry sector specialties and are as connected to their counterparts in the more traditional institutional investor community than maybe even some of the companies they're investing in. They have a very close relationship, and that can play out in a number of ways. Then there are the M&A focused activists. They're the ones who come into the stock, say, you should do a spinoff or you should sell the company. That's it. We're not talking about improving how you operate. Probably have a shorter term investment horizon. And lately, because of a couple of cases and a couple of other oddities in the law, they've been pursuing appraisals when M&A has occurred. Then finally, the balance sheet focused activists. They're the ones who say, buy back your stock. They're seeking dividends and the like. Not all activists are the same. Not all financial activists are the same. There are degrees of aggressiveness going from top to bottom. There are the reluctivists. I say, gee whiz, I don't really want to do this, but I guess I have to. The suggestivists, wouldn't it be good? Constructivists, I'm here to help you. And then there are the terrorists. I'm sorry. Peter, you said you had a new term for this. Come on.
Well, just only for our own firm.
Okay.
And actually, it was Larry Fink who coined the name for Trian, and he calls us highly engaged share owners.
All right. That's not going to catch on.
engaged.
It's got to be an ist. All right. Then the other thing to point out about financially oriented activists is that they are replicating, right? So some of the first generation activists have spawned others, Icon, Corvex, Pershing Square, Mercado. There are lots more names I could put up here. They have been successful. The governance activists, as I said, on the adopting of best practices, see what they've done to staggered boards over a period of time. Also, most companies now are paying attention when they get a letter from Vanguard or from BlackRock saying, we're into shareholder engagement, you should come see us. Most companies are trying to do that. They're being very careful about which of their directors they put out in front of the institutional investors. Some have expressed some frustration because they say, okay, we'd like to come see you, and they have heard from some institutions, I'm not saying BlackRock, but some institutions they're saying, oh, we don't really need to see you, we're too busy. Or by all means, just don't come see us during proxy season. We're much too busy during that period. There has been growth in this industry. You can see the statistics for those of you in the back if this is too small. Just 6 years ago, there was $47 billion under management, according to at least one census. It's more than doubled in the last 6 years. The number of funds have increased. There have been great successes. Maybe of late, not so many successes, but nevertheless, there are successes. This is clearly an asset category for some investors. Which then gets us to the key questions. And we're going to start out by talking about even when one form of activist doesn't play both roles, is there a relationship between the governance activists, the principally oriented toward governance, and those who are financially oriented. And Michele, I think you're going to start us off on that.
Absolutely, thank you. So the stance that we take on interacting with activist firms is that once they have put their proposals for change in the public domain, we will meet with the activist investor. We tend not to meet with some activist investors, largely because of our experience of engaging with them in the past, and we've found it not particularly productive or fruitful. But the most important thing for us is to understand the merits of what they are putting forward as their case for change, and then to have that in our minds as we're engaging with the company to hear the company's perspective. Now, BlackRock does invest a significant portion of our equity investments through index strategies, which means our clients are long-term, locked-in investors. So we need to look at all of these proposals through the lens of what is going to happen in the next 6 months, 12 months, 3 years, 5 years, and beyond, because that's the timeline over which our clients will be invested. Our general tendency is, if we believe management understands the need for change and has a board that will hold them accountable for change, then we'd rather they drove the change than introducing outside directors in, which can create uncertainty. That said, as many of you will know, 2016, very few shareholder activist slates went to a vote. A lot more board seats were negotiated between the activists and the companies. In 2015 was the last year there was really quite a lot of voting on this, and we supported the activists in about half the situations that went to a vote. We can talk about that more in a minute.
There is a rumor, and I ask you to comment on it, and Peter might comment on it as well, and John jump in, that there's a thing called an RFA, a request for activism, where the institution will go to an activist and say, we think this is a situation you should look at, and you might be helpful with us. So the initiating force is actually the institutional holder, and John could comment on that as well, because he wears many hats. So is RFA fake news, alternative facts?
I'm foreign, I'm not allowed to comment on American politics. Or certainly not in public. In any case, from BlackRock's perspective, it's very unlikely that we would be doing that. And in large part, you can never say never, I understand. But equally, there's a difference between someone deliberately calling up an activist and saying, will you look at this company, please? And investors mixing at investor days and so on and sharing perspectives, which does happen as well. And I can't judge the veracity of some of the claims. What I would say is it demonstrates a couple of things, assuming it is true. The first thing is that being an activist is a really specialist activity, and your mainstream asset managers are not necessarily well equipped to do it. And in part, it's the level of detail in the analysis that activists go into, and also the skills of the people they retain. And Peter's much better equipped to talk about that than I am. But the second thing is, I think there are issues in US around filing that mean a lot of mainstream investors are very nervous about going into even a gray territory of being what in SEC language is called passive investor, which is not index, but supportive of management, and really pushing and challenging management. And I think that's problematic simply because if your mainstream investors are nervous about really challenging management and even going to the length of suggesting that there might be a need for a change in leadership at a company, then it does leave a gap open that only board members can fill, and too many boards don't fill it, which is why Peter has such a successful fund.
Peter, talk about RFAs.
So no one has actually formally come to us and said, we want you to go after a particular company, but a very important part of the way we operate, and I think, take a little bit of a step backward, we approach our investments as operating businessmen, because our history of our firm, going back before we started Trian Partners in 2005, Nelson Peltz and I built a number of companies. They were always public, and we kept them public, but we invested in companies that were underperforming from an operating point of view and tried to get management to think about their businesses as if they owned 100%. And what kind of decision making would they make if they were the owners of the business and not thinking about guidance that's very short-term oriented and short-term results that either are driven by poor compensation programs or a whole host of other things that create short-termism on the part of management, not just on the part of investors. So we've always had a long-term approach. We've always focused on the operating side of a business. What's going to drive the business? What should you be investing in? Are margins appropriate? Are costs out of whack? Is management the right team? And then work with the management, that's our first objective, and work through the boards. And a very important part of the ability to be successful, because over the years we've moved up the market cap level dramatically from our first investment, which was Wendy's, which we actually still retain as an investor, which at the time had a $2 billion market cap, today is a $5 billion market cap, to our most recent investment, which we announced a few weeks ago, of Procter & Gamble. So,
and on Procter & Gamble, you put in?
We put in $3.5 billion. So
let's pause on that number. Okay, go ahead.
So we have a very concentrated portfolio of about 8 to 10 investments at any one time, and we really become, and we're only in 3 verticals: anything consumer, financial services that are primarily services, not major balance sheets, and industrial. And we have an organization that's very focused, to Michele's point. Index funds have come later, but we've now developed really good relationships with them as well.
John, you have a perspective on the, as Michele called it, the mainline investor, which you definitely are, and the activist, the interrelationship there?
Well, this idea of the RFA, we would typically not do that. We invest in very similar verticals to Peter, and I think one difference is that we own stocks, as you know, for 20, 25 years. We are very, very long-term investors, and so therefore we want to build constructive relationships with the management teams and a level of trust, and try to, hopefully they think of us as partners, where we can be kind of like an informal board of asking them good questions and pushing on things that are important to us, but not doing it in that terrorist way that you suggest. And I think that helps us to be able to get access to better information and be able to be more effective shareholders by doing it in a constructive way.
Okay. Peter, what are the attributes of the target companies, maybe even the directors of those companies that you would target? You can answer this generally, or you can talk about Procter & Gamble.
Well, I don't want to talk about that's it. Procter & Gamble, we're just starting the honeymoon season, so I don't want to start anything. I mean, you know, look, what John just said about trying to become partners with the companies is very much the way we operate. Yeah. Although, you know, when we show up, I don't think we get the same kind of welcome that Ariel would. The first reaction is to call their banker and to call Wachtel.
Did you bring a food taster? Or?
Not, hopefully not. Okay. But you know, but I think we've developed a reputation over time where we come with the idea that we're here to help. And when you think about what we should be doing, it has to be a partnership, constructive relationship with the company, because if we're on the board with 1 or 2 board members. You know, we've only had 2 proxy contests in our life. The first one we actually got 2 board members. The second one we lost. We lost, that was DuPont. We lost the battle and won the war because we ended up, the company missed its numbers, changed its CEO, and then we were instrumental in bringing in their new CEO and in getting the merger with Dow, which is turning out to be a very successful one, a great company. But at the end of the day, the way we interact with companies, I'm not exactly answering your specific question, but the way we interact with companies is we have to use the power of the argument to convince management and the board that we know what we're talking about, and that if they follow what we're advocating, that it's going to be valuable for the company over the long term. And, you know, so in most cases, in some cases, we're not on the board at all. We're not on the board of GE. In some cases, we have one board member. In a couple of cases, we have two. In the case of a company called Pentair, which is an industrial company, we have one board member, and they've allowed two of our younger partners to be observers. So they go to board meetings, they don't have a vote, but they have access to all the inside information, which has been terrific. But it has to be a collaborative effort, and there has to be mutual respect. And although the knee-jerk reaction is, I don't want somebody looking over my shoulder and telling me how to run the business, you know, if we conduct ourselves properly, then they're going to listen to what we have to say. If what we have to say makes no sense, they're not going to do it. But we do an enormous amount of homework. We have 8 to 10 names at any one time. We write a white paper that can be as long as 100 pages. It goes into the nitty-gritty and comparative with their peers, et cetera. So we come armed with pretty good data that really shows what needs to be done. And it's not, you know, fire 6 people over here and 12 people over there. Think about your culture, think about your organization structure, think about running the business on a much more efficient basis, and the companies we target are the ones that are not doing that.
So Peter mentioned white papers. These are really awesome pieces of work. They sometimes spend years in the making, and so when you're advising a client that is concerned about potential activism, you say, imagine what the activists would write about you in the white paper and be prepared with the responding brief, as it were, so that the white paper is not out there forever and your response comes late. So we did this with one client. We showed the response, or what the white paper would look like, to the CEO and said, you know, we're going to show this to the board. And he said, no, you're not. So one of the pieces of conventional wisdom is that when it does come to a proxy contest and you're trying to decide which director to pick off, you will often go after the longest tenured one, picking up on the academic literature that says after 8 years you're not really independent and the like. When you see a proxy contest and you see who's being targeted as the individual director, what moves you most, Michele?
Meeting them.
Interesting.
And it very readily comes forward whether they're credible or not. And you mentioned, yes, we've been pushing for the last few years for increased engagement between shareholders and directors. And for those of you who are directors, don't panic. This doesn't mean you have to do a roadshow every 6 months. When a director is the only credible party to defend the company or the management's approach. And in activist stories, that's absolutely the case. So the thing that I find fascinating in those meetings is sometimes how ill-prepared directors are, how ill-versed they are in what the issues are at the company, and how ill-versed they are in what their shareholder base looks like. So as I mentioned, BlackRock is a significantly indexed investor. For most US companies, in the index strategies alone, we will be an investor of between 4 and 6% of a company's shares. And we get a director who comes in and says, if you like what the activists are proposing and don't like what we are doing, why don't you sell your shares? Then you go back to, do you understand what indexing is? and very patiently explain financial markets.
It's only been around for about 40 years.
Exactly. But it is, I think, very important to meet the directors because it's incredibly difficult to choose just based on a biographical note that's in the company's disclosures. And again, I think a lot of companies don't explain well enough what contributions directors make until they're on the back foot. And when we've been in an activist situation where you see that the directors are credible, they do understand the business, they do understand the flaws in management's approach or strategy to date, and they have a very articulate explanation of what the board is going to do to support management to bring about change, then we leave them to it. Where they fumble and you sort of think, why did you even come to this meeting? That is when we're likely to support change.
So John, companies are often on their back foot, as Michele said. If you look at the statistics, the percentage of companies that settle rather than fight all the way to a vote in a proxy contest is really very, very high. Mm-hmm. Is it too high? Are companies settling too quickly?
I don't think so. I think that I've been on one horror story where there was sort of terrorist activists involved. I think you actually, I might have called you in to help me on that one.
I think so. You don't
yes.
always call Wachtel.
Yeah, I know. And, you know, literally.
Last time I invite you, Peter, yeah.
As they, you know, the first thing was the CEO was spending more than half his time, you know, counting votes, trying to figure out whether he could win the proxy. He totally lost sight of being able to manage the business. And the company fundamentals deteriorated, which of course gave the activists even more influence. And then slowly but surely you would get one director onto the board, and they would come into the boardroom and really literally terrorize people. You know, scream at people, threaten people. You'd have people calling you at home and saying that if you didn't vote a certain way, they would, you know, come after you and your family and embarrass you in public. So I think that if you get into a war with your activist shareholders in a public way, it can just really impact the company fundamentals in a very severe way, because you can't run the business if you're at war with your shareholders. So the idea to be able to have a thoughtful conversation along the way, build rapport with shareholders, and then settle in a way that is not contentious.
Yeah.
You know.
Can I
So-
just add something?
Go ahead.
And I think it is really interesting because it's always incredibly subjective, I think, whether to settle, whether to fight. And I think one also has to have a little bit of humility, or particularly the activists do, because they don't always get it right as either. And I know you guys are involved in one situation which has two activists on the board. I don't know if they're still, both of you are still there, but in any case, there was a time where the different perspectives in the room made it very difficult for anyone to move forward. I think Valiant is one of the most public examples of running businesses is hard. Good ideas are helpful, but they're not always right.
Peter, you were in the Bank of New York, right?
We still are.
And you settled, and then the company had a knock at the door, and there was Mercado.
Yeah, so we were in Bank of New York. We became large shareholders in Bank of New York. Our thesis was that their costs were, you know, that they hadn't addressed the dramatic changes that the market crash or the whatever you want to call the financial meltdown created and impacted their business, and so their costs were out of whack. They didn't address it. And we got one board seat and developed a very good rapport. And then another active investor came in with a thesis that really had very little data behind it, but basically said, fire the CEO. That was the entire MO, fire the CEO. We actually felt the CEO was a very intelligent, very smart guy who was willing to hear what we had to say and recognize the issues that had to be done. It was a company that had been, you know, it was a merger of Bank of New York and Mellon, and had different cultures, and it took a long time for those cultures to become one, which is often, culture is a big issue in terms of a success of a company, particularly one that's grown through acquisition over time. And we were getting a lot of headway in terms of working with the board and with the CEO to get things done. And we basically publicly said, we totally disagree. We think they're wrong, and we're going to continue to support management. They ultimately moved on, and Bank of New York's been one of our most successful. We've virtually doubled their operating margins. The company's doing extremely well in spite of, this was before any interest rate benefit whatsoever. And just recently, Ed Gordon, who's our partner who's on that board, was at a conference in Tulane, which is the big corporate governance conference, with Gerald Hassel, who's the CEO, and Gerald was basically explaining the positive influences that we had on the board. So I want to go back to the comment about directors, though, that you talked about, because I think one of the biggest issues on boards is that directors, and I was recently reading Larry Fink's letter to his clients about strategy and about how the board's responsibility is to get and really understand the strategy of the business. And what we've seen over the years is that primarily the companies we invest in, because there's something wrong, otherwise we wouldn't be investing, is that there's a huge disconnect in the boardroom. Not that they're not intelligent members of the board. I mean, once Sarbanes-Oxley came in and required a different type of director than the old days where they were basically the CEO's buddies and golfing buddies and insurance guy and his lawyer. You know, today they're sitting CEOs, they're sophisticated people, but rarely do they get that involved in the business. And one of the things that's interesting is that the CEOs today are still very successful, particularly in large companies, of getting people on their board who are not in their own industry, under the guise of they don't want anybody who would have competitive knowledge. Well, what that results in is it means that the board is made up of people who don't know that industry, and management has what we call a monopoly of information. They know everything about the company, and the board only knows what they're told. So the typical board meeting is you get a book this thick about 3 days before a board meeting, or now because of technology you get it on an iPad, which has allowed the management to give you even more information. But the ability to sort through that for a guy who's a CEO of another company who's on a board of X, Y, and Z company, he doesn't have the time to really do it. So he goes to a board meeting and he basically hears what management presents. And management puts their spin on what's happening in the company, and most of the time it's a positive spin because they're defending their own track record. And the board members, first of all, some of them are sitting CEOs, so they wouldn't want somebody to be second-guessing them and their board, so they're a little more supportive of the CEO and the board they're on. But they don't have the ammunition. When we show up on a board, and again, we're one person out of a board of 8 to 12 or 14, we have already established, we sign CAs for our organization. We have a team that works with the company. We get a data dump that gives us a huge amount of information of what's going on. We very often ask for items to be brought on the agenda of a board meeting. And we start educating and having the dialogue be much more about the operations, the strategy, the capital deployment, rather than board members are typically very comfortable talking about compensation, talking about governance, but when you start talking about the nitty-gritty of the business, they don't really want to talk. They're not equipped. And we've been able to change the dialogue in the board we've seen over time in almost every situation. The rest of the board all of a sudden starts to get really engaged because they now realize that they're learning much more about the business and their responsibility moves way up.
This is why I say to a board, before you settle and put an activist representative on the board, understand they will have outsized influence in the boardroom. They own more than anybody else. I mean, it's not really always their money, but they say grace over more than you do. And secondly, they've got a staff. They're not reading the board book on the plane.
Right.
And so they are going to be way ahead of you. But okay, so John, you sit on 2 public boards. You've probably sat on a total of 10 over the course of your career. Respond.
Well, it's actually I wasn't
talking about any of his.
No, of course not.
I mean, on one hand, when I'm, as everyone knows, since I got out of college, I've gone to McDonald's every day, and so being on the McDonald's board, I can truly understand the issues there. I think that's why Andy helped recruit me to the board. And but you don't always have that privilege of loving the product. And so what I think is a slightly different answer is that I think it's okay for people to stay in their zone, as what Warren Buffett would say, in their circle of competence. So the example I always give, that I was on the Princeton board and John Weinberg was the head of Goldman Sachs. And for some reason, he was on the Buildings and Grounds Committee. And he's like, I should be on the Finance Committee. And that's where I can really make a difference. But people felt like it was comfortable to put people on different committees having nothing to do with their expertise. And I've seen that in the corporate boardroom all the time, where you'll have someone who's a former Secretary of Homeland Security and not being engaged to help the board understand some of the key issues around how they can keep that company safe and keep our world safe. So I think it's really can be that you can add value. If you're someone who's an expert in the investment world, kind of like we are, you can have a lot to do with how thinking about the company's pension plan, or thinking about how they think about their stock buybacks, and how they make capital allocation decisions that are so critical. You might not have to be the inside expert on, nuclear, issues that are, maybe there's a nuclear scientist who can be better able to do that. So I think it's okay for people to find a specialty, find a niche, add value in their area, and hopefully have a diverse group of board members who bring different perspectives and have deep expertise.
Wait. Hold on, Peter. Michele, when you're looking at a board, where do you expect the board to draw this important line between oversight, the traditional role of the board, and digging in? More like, Peter, what you're describing is almost like a venture capital approach.
Well, I think in order to not be in a situation where you're attractive to an activist who wants to do the deep dive type of board role, I think it is about asking probing questions. Mm-hmm. And when we engage with companies and company management and board directors, that's what we're doing. We're not trying to suggest that we have a better idea how to run a company than management themselves do, because we don't. But in asking questions to get the company to explain and justify why the approach it is taking is the right one for long-term investors, I think it becomes very clear the extent to which that can be articulated well. And so when we're looking at boards, we're looking to see how in the round that group of people have the skills and expertise to support management to deliver the strategy. And this is why, again, and for the last few years, Larry Fink, our CEO, has written to the companies we invest in saying, set out a long-term strategy, set out the milestones by which we should hold you accountable, and then tell us how you're doing. Because without that framing, it's really hard to assess whether the board is appropriate, whether management have done a good job, and whether we're on track for long-term value creation.
Go ahead.
I got a comment on this. So I clearly, I agree with John that people have different areas of competence and different areas of expertise, and they clearly should be bringing those to help a board and help a company. And clearly, if someone's got an experience in Homeland Security, then he should really be helping a company understand its cyber risks and all things like that. However, at the end of the day, the responsibility of the entire board is to hold the CEO and the management team accountable for following the strategy that they've agreed on and implementing it and executing it properly. So you can't just simply abdicate that holding accountable because you don't have the expertise. You have to learn. You have to, and we don't go in and say, we want you to change the color of your product, or we want you to invent a new product. We go in and say, your margins are totally out of whack against your peers. We're going to say, you've got to figure out how to restructure, and we want the whole board to get their arms around that.
And that's there's an appropriate balance. That's one thing I've learned from Andy McKenna. Appropriate balance of when board members can get too engaged and too involved with the minutia and thinking they're micromanaging the company. And so sometimes they hear from the good governance types that they're supposed to be true experts on everything. And I think that can be a disastrous kind of chemistry in a boardroom when everyone's trying to run everything.
At the risk of publicly agreeing with Peter, I will say that if you're in the depth to which a board should go in terms of the management is really a function about how things are going.
You bet.
So if you're coming into a situation where things aren't going well, I think it's perfectly legit, right? Okay. We are the economic club, so we're supposed to get to the ultimate question. And there's subsidiary questions, but we want to leave time for all of you to ask this, take advantage of this panel and ask them questions. Take advantage in a positive sort of way. So lightning round, is activism good for the economy?
I think elective activism is bad for the economy. So in the corollary, yes.
Okay.
Good activism, meaning activists who are trying to help a company build long-term value, is very good for the economy. the ones who are the terrorists or taking shots at trying to make a quick return for themselves and move on is not.
John?
I think in the long run, they're more dangerous than not. And I think that long-term investing is the best way to invest. You know, we're big Warren Buffett believers that you want to find great businesses for the long run. And I think the short-termism, which is helped by activism, I think is not healthy for the economy.
To give you a little perspective on John's answer, the logo for Ariel Capital is a tortoise.
Thank you.
I'm here for you, John.
But
I think your answers were really focused on financial activism, so let me take it down another step, which is this first subsidiary question. Do you think, and John, from your perspective as a director, has governance-oriented activism improved board-level decision-making? In other words, annually elected, separation of chair and CEO, that kind of stuff.
I think for the most part, there's been a lot of good that's happened there. And the conscientiousness of boards is so much more than it was 20, 25 years ago. And the the rigor that goes through in the preparation and the way the meetings run, and listening to their shareholders. We spend more and more time than ever on corporate boards understanding who our shareholders are. And we used to not do that 25 years ago. And so I think ultimately governance changes have been healthy.
So I think the governance things have been very healthy, getting rid of staggered, but having shareholders have access. One of the things, you asked a question right at the beginning of Michele about how do you decide when one director is being targeted in a proxy contest. To me, the fact that you have, because the structure of proxies today is so antiquated that you have to have a slate versus another slate is ridiculous. We should have a universal proxy card. So if you want to add one director, you don't have to pick the one you want to remove. I mean, that to me makes no sense because it's very hard to judge from just a bio. But, you know, to me, at the end of the day, anything that gets more of a shareholder mentality into the boardroom and where management starts feeling a responsibility to a broad group of constituencies, to employees, to the community, but also to the shareholders, is healthy.
I think the biggest weakness in U.S. market is U.S. business, U.S. investors, U.S. regulators collectively never came up with a market-level code of corporate governance. So what we have has been developed by private ordering, which I know from many, many conversations Americans are very comfortable with. What it means is we have a mishmash of rules around shareholder rights, shareholder access, and other things. I think the single most important thing that has changed in the U.S. is majority vote standard for director elections. Because if we can remove directors, you'll be focused on what shareholders are concerned about, and you'll listen to what shareholder feedback is. It isn't necessarily that you do what the shareholders say, but you know if you do something different and don't explain why that's the right thing to do, then you can be removed from the board.
We could go on forever, but we want to give people a chance to ask questions. Adele.
Yes, first of all, thank you all very much. I'm going to shift a little bit.
There's a microphone for you.
I don't think I need one. I'd like to shift a little bit to the question of social issues. When de Klerk was here about 3 years ago, I told him that I had been head of one of the universities that was the first to divest in companies doing business in South Africa. And he said to me, when the divestment movement began, I knew apartheid had to end. So I'm interested in your comments about social issues in this whole investment, shareholder investment piece.
Michele, why don't you start with the extent to which you focus on CSR?
We look at the environmental and social factors that are a material part of a company's business. But we think that the shareholder proposal process is not the best way to engage companies on those issues. And large part it's to do with the technicalities of the shareholder proposal process. But most social and environmental issues are relatively nuanced, and you do end up getting down into the way the company is operated. And why we look at them is not because we're promoting either a social or an environmental agenda. We don't have one. We had the only thing every single one of our clients has asked us to do is generate a return on their assets. but we look at environmental and social factors in a business to get a sense of the quality of leadership and the operational excellence within that firm. Because in the long term, when companies don't manage what fits under the banner of environmental and social in our parlance, that's usually when you have a well blow up, or you have a product recall, or litigation that costs enormous amounts of shareholder funds.
I would just add to that, we don't invest in tobacco companies, we don't invest in handgun companies, partly for the same reasons. This is the kind of endless litigation that could be there, the black hole risks, so you're tying your economic interest also to the social issue at the same time. But on the other positive side, we do push all of our companies on diversity, to ask the management teams about the number of women and people of color in leadership roles and on their boards, and say if you're going to be a 21st century company, you have to have a management team that looks like America. If it looks like a 1955 company, you're telling us something about your vision as a management team. And so we do push that very hard.
Yeah, I would add that it's actually CSR, corporate social responsibility, has become finally an area that people recognize, that businesses recognize is an important business component. It's good for your brand if you're a consumer. In today's world, everybody is looking to market to millennials, okay? Millennials are a totally different group in terms of what they're interested in, but what ingredients are critical to them, how a company behaves is critical to them. So it's good business, and at the end of the day, it's also understanding the changes in the environment have an impact on a lot of things that people are doing, whether it's where their factories are located or you know, if it's in the real estate business, you know, all of that's very critical.
Adele, I tell my students that if the entity doesn't have a good reputation on CSR and those kinds of issues, then when they have a crisis, they're not going to catch a break. Absolutely. And when they're trying to influence decision makers in the legislature or regulatory decision makers, they will not have quite the same credibility. So it gets around to, if you consider the primacy of shareholder interests and it's to have a good return, ultimately it's good for the shareholders. Melody?
Yes, I was wondering how you feel about the proliferation of the super voting class shares, especially in the tech industry, and how tech executives right now, especially the entrepreneurs, have no interest in giving shareholders access. And thinking about it from the flip side, if you were that executive and you were starting a business and you had a great idea, would you see their point of view and think, well, I'd do it the same way? Is this an SEC issue where something needs to change from the perspective of regulation? And does it change the nature of activism long term if that becomes the way that companies are formed?
So, you know, actually Michele and I were having that conversation at breakfast this morning. I think that we would never invest. I mean, it's a protection that the companies that have two classes of voting have created that really prevent them from being a target. I mean, one of the first screens we do when we look at a company that we think is underperforming is, what's the corporate structure? You know, is it in a geographic venue that the shareholder access is very difficult? You know, a lot of European and certainly Far East companies make it very difficult. But does it have a controlling shareholder? Does it have two classes of stock? And we won't go near those companies because we know at the end of the day they can just tell us to go pound sand. I don't think it's healthy, but it seems like the investment community, in terms of allowing companies to go public, from a financial point of view, primarily the Silicon Valley type companies, have never forced any shareholder rights on those companies.
And I'm sure many of you have heard people like Marc Andreessen speak, and he says, I don't understand why a company would go public without the protection of non-voting shares. So that's not necessarily helpful when one of the leading voices of Silicon Valley is promoting this as a way to public markets. I suspect it's going to be a trend that will pick up, and then there are going to be a number of disasters, domino effect, and then everyone's going to go back to, this is a really dumb idea.
Do your active managers stay away from dual-class stock companies?
It's always on a case-by-case basis. But I do think there needs to be greater scrutiny of who's on the boards of those kind of companies. And although you can't have an influence as an investor using voting, you can decide not to invest in the ones where you think they're too insular. And I think insularity is a huge issue in the tech world, which is even bigger. I just want to go on a little digression. In Europe, we have a different issue around differentiated voting rights, which is that when you're a long-term investor, you get to double up your voting rights. We think that's equally bad because what it has really achieved is the same kind of entrenchment you get in Silicon Valley, but just a different set of people who are entrenched.
It's often called families. Right?
Families, actually government.
Right.
Government is a big one.
Oh, sorry. Over. Yes.
Peter, you talked a little bit about culture when you were referring to the Bank of New York. Can you elaborate a little more in terms of the responsibility of the board of directors with respects to the culture and the management, whether or not that topic is presented when there is a board of directors?
Well, I think that, culture is a very amorphous thing. So it's how do you define the culture of a company? A really well-run company has a culture that is looking for collaboration and is trying to promote the best ideas to come to the surface. And what we've seen in so many companies is the culture is an amalgam of a whole bunch of different cultures as a result of different mergers. And no one ever took a step back and said, okay, how do we run this business that's made up of 5 different acquisitions that are of similar size, and start with what we call a blank sheet of paper. Today there's a technique, they call it zero-based budgeting, but it's really, how should the organization structure empower employees and management to have control over their own destiny? And so the culture is intertwined with the structure of the business. Culture as it relates to how you communicate with your constituencies is a different thing. CSR type of culture can be very good, but the organization culture cannot be, where people don't have, there are a lot of companies, the worst performers that we've seen, where people are competing with each other within an organization for the ability to move to a higher position. And if a culture is that, and there's no collaboration, and the structure doesn't allow people to work with each other to advance the individual components of the business, then it's a recipe for disaster.
I can see we're about to get the hook. We could go on so long that when you went outside, it wouldn't be raining. But we have one more question over here.
It'll be a quick question. Peter, just in response to John's comment on long-term hold, what is your average hold? Because at least I heard that, like Wendy's, you've been holding for a long time, so I'm curious.
We've held Wendy's for 12 years since the beginning of the fund, and we love the business, and it continues to grow. And I go to Wendy's almost as often as John goes to McDonald's, which is a problem. But our average hold on companies that we've been on the board is over 5 years. And we're very much long-term. If you look at the average hold of a typical mutual fund, it's like 18 months. And we're much more long-term.
That's very rare, though. As you know, in this industry, Peter's firm has a unique culture around long-term investing.
Michele, Peter, and John, thank you so much for your insightful conversations today. We really appreciate it.